Trading and investing both involve seeking profit in the stock market, but they pursue that goal in different ways. Traders jump in and out of stocks within weeks, days, even minutes, with the aim of short-term profits. They'd often focus on a stock's technical factors rather than a company's long-term prospects. What matters to traders is which direction the stock will move next and how the trader can profit from that move. Investors have a longer-term outlook. They think in terms of years and often hold stocks through the market's ups and downs. Timing is the starkest difference between traders and investors, but their focus also differs dramatically. Investors study a company's potential for long-term growth or value, but traders often take advantage of small mispricings in the market, such as when political uncertainty in a foreign country temporarily pushes down the share price of a U.S. manufacturer. So-called scalp traders might be in a position for just minutes. Day traders are focused on the trading day, while swing traders invest for days or weeks. That's an overview for the whole topic, but before we get into it, please don't forget to like and share this video with friends, and also hit the notification bell to stay updated. Investing. The goal of investing is to gradually build wealth over an extended period of time through the buying and holding of a portfolio of stocks, baskets of stocks, mutual funds, bonds, and other investment instruments. Investments often are held for a period of years or even decades, taking advantage of perks like interest, dividends, and stock splits along the way. While markets inevitably fluctuate, investors will ride out the downtrends with the expectation that prices will rebound and any losses eventually will be recovered. Investors typically are more concerned with market fundamentals, such as price-to-earnings, ratios, and management forecasts. Anyone who has a 401k or an IRA is investing, even if they are not tracking the performance of their holdings on a daily basis. Since the goal is to grow a retirement account over the course of decades, the day-to-day fluctuations of different mutual funds are less important than consistent growth over an extended period. Long-term investment. In stark contrast to trading, long-term investors generally focus on diversification, risk-adjusted returns, staying fully invested, low turnover, and time-tested investment principles. Traders try to pick the next unicorn or turn a quick profit. Long-term investors usually seek to adopt a formal asset allocation strategy and make few changes. Diversification is a strategy to help reduce volatility and improve returns on a risk-adjusted basis. During a downturn, a broad-based portfolio generally won't lose as much as a concentrated allocation could. Long-term investors diversify through different asset classes like stocks and bonds, and within an asset class like small and mid-cap U.S. equity. Long-term investors aren't trying to hit home runs or strike out. They're looking for reliable base hits and runs batted in. Home runs are more exciting, but RBIs win games. Trading. Trading involves more frequent transactions, such as the buying and selling of stocks, commodities, currency pairs, or other instruments. The goal is to generate returns that outperform buy and hold investing. While investors may be content with annual returns of 10% to 15%, traders might seek a 10% return each month. Trading profits are generated by buying at a lower price and selling at a higher price within a relatively short period of time. The reverse also is true. Trading profits can be made by selling at a higher price and buying to cover at a lower price, known as selling short, to profit in falling markets. While buy and hold investors wait out less profitable positions, traders seek to make profits within a specified period of time and often use a protective stop-loss order to automatically close out losing positions at a predetermined price level. Traders often employ technical analysis tools, such as moving averages and stochastic oscillators, to find high-probability trading setups. Pros and cons of trading. Here are some recent examples of how volatile returns from trading and stock picking can be. GameStop investors who bought GameStop stock on January 27, 2021 would have lost nearly 55% of their investment by April 21, 2021. The S&P 500 total return was nearly 12% over this period. If you bought GameStop just one day earlier, you'd actually have a 7% gain, versus nearly 9% for the S&P 500. And buying the stock on January 1st and selling on January 27th would have produced an incredible 1,740% return versus the S&P, which was essentially flat. Tesla and Hertz. In 2020, Tesla returned over 743% versus a loss of nearly 92% for beleaguered Hertz, while the S&P 500 total return was over 18%. Year-to-date in 2021, to April 21st, Tesla's return is about 5.5%, while Hertz is nearly 36%. Once again, the S&P sits in the middle at 11.6%. Risk versus return. These examples are intentionally cherry-picked to illustrate the volatility, risk, and potential rewards for traders. Even if a stock has been producing huge returns, you can't benefit unless you happen to buy and sell at the right time. Remember, stocks don't always go up. One of the reasons it's so hard to find the right time to buy and sell stocks is because there's no telling how markets will react to changes in capital markets. Having a play account to dabble in stock picking with a full understanding of the risks is perhaps the best way for individual investors to approach trading. In most cases, trading versus investing shouldn't be a binary decision. Instead, consider a bucketed strategy to invest for long-term needs and wants. To the extent you have the interest and desire to pick stocks, only trade with an amount that won't materially impact your financials if it fell to zero. Taxes. One of the challenges of day trading in a brokerage account is the tax implications. It's easy to trade stocks with just a couple of clicks, but the tax impact isn't always as clear. Short-term capital gains are taxed as regular income, which can push you into a higher tax bracket and change your eligibility for tax deductions or credits. Wash sales can be difficult to track at some brokerage firms like Robinhood. Non-traditional investing platforms like SoFi and Robinhood also don't permit the sale of specific investment lots. This means you can't isolate shares to realize a loss to offset other gains or minimize a taxable gain. Pros and cons of long-term investing. Make no mistake, long-term investing isn't sexy. It's about making a plan, sticking to it, and taking on only as much investment risk necessary to reach your goals. FOMO. It's a common misconception that individuals need to invest really aggressively to retire early or become financially independent. When it comes to meeting financial goals, reducing volatility really matters. If your account loses 25%, you'll need a 33% gain just to get back to even. And that assumes the stock comes back at all. The biggest downside of long-term investing is the fear of missing out, FOMO. If you're casually picking stocks or reading about the growth of Bitcoin, it's tempting to think, if only I. But the reality is that no one has a crystal ball. Consider what you think would be worse, putting only 5% of your money in a stock that goes on to double or putting 50% of your money in a stock that gets cut in half and never recovers. Tax planning opportunities. Long-term investing can also offer tax planning opportunities typically unavailable at a stock picking approach. When you're not trading all the time, you reduce portfolio turnover, which can help lower your tax bill. And when you do need to sell a fund, if you're working with a financial advisor, they can work to offset the tax impact by picking specific lots or tax loss harvesting. When trading or investing, make decisions for your risk tolerance and goals, not someone else's. It's easy to get caught up in the markets these days. Every day there's a headline about a stock soaring or cryptocurrency making millionaires, even if it began as a joke. When deciding how to allocate your money between trading and investing, always keep your value at risk in mind. Ask yourself what you're hoping to achieve and the impact on your financials if it doesn't go as planned. In the financial markets, the only sure thing is that there are no sure things. Unfortunately, the recent gamification of trading makes it much easier for people to forget they have real money on the line. Trading wisely. If you're interested in trading, here are some tips for minimizing risk. Create a plan that dictates when you'll buy and sell. For example, you might decide to sell if a stock rises or falls a certain percentage. Stick to your plan. Even experienced traders let their reasoning for holding certain stocks shift. That's the hardest part of being a trader, sticking to your rules, says Matt Sainholtz, a former professional trader and now co-owner of Tobias Financial Advisors in Plantation, Florida. Figure out how much money you can afford to lose, and don't trade more than that. Laren Odom, founder of Chastain Wealth Management in Atlanta, suggests trading no more than 5% of your investable assets. Go in with open eyes. The most advanced traders use sophisticated algorithms to trade on any small inefficiencies in the market, says Kirsty Peeve, a portfolio manager at Halpern Financial in Ashburn, Virginia. The margin of opportunity is so slim now. They may be aiming for a 0.01% gain on millions of dollars. The average person is priced out of this playing field. Know your taxes. You might be able to take a tax deduction for trading costs, but you might also owe taxes. Rates on short-term gains range from 10% to 37%. See what you'll owe on short and long-term capital gains. Investing wisely. Investing is a way to build long-term wealth. Just ask anyone who bought stocks in March 2009. The Standard & Poor's 500 index is up about 250% since then. A recent study shows investing in the stock market can return millions of more retirement dollars than putting money in a traditional savings account or keeping it in cash. Here are tips for doing it right. Create an investment plan for buying, selling, and rebalancing your holdings. For example, some people sell some holdings and buy others to get the portfolio back in line with original goals after market moves have pushed it out of whack. Be prepared for the long haul. You'll need patience and discipline to stick through the market's ups and downs. Hope this guide is useful to you to decide which is better for you, debit or credit card. Please give this video a thumbs up, subscribe to the channel, and comment below your thoughts or questions. Thank you for watching, and till next time.